Robert, let's start today with trade tensions with China. In your report today, you say things have escalated. So how could that impact the economy going forward?
We haven't seen that much evidence of tension from trade in the real data to date. My expectation is we are going to start to see it. We are seeing a lot of anecdotal reports when you look at the Beige Book and the ISM surveys, a lot of comments about companies saying prices are up and they're concerned about trade. But we're not seeing it yet showing up in things like the employment numbers and other things like that. But I think if this keeps going here over the next couple of months, we'll start to see evidence that trade is having a bigger drag on the U.S. economy.
All right, well, speaking of payroll, July payrolls increased by 157,000 net new jobs, but that was below expectations. So what do you make of that?
Yes, and it's really not a bad number. And the issue here was that expectations were sort of bumped up a lot by the pretty strong ADP report we got on Wednesday, which was plus 213,000 just private sector jobs. So that got everyone's expectations up. Now, those two surveys are completely separate. They generally track well over time, but they don't have to go in lockstep. So 157 in the official BLS numbers, not bad at all.
Speaking of manufacturing, you touched on that a minute ago, but what were the numbers, the most recent numbers? What do they tell us about manufacturing currently?
Well, we did see both the ISM manufacturing and the non-manufacturing indexes. Those numbers have been up close to 60 on both those indexes here for a couple months, which was very, very good. And to see both those indexes at 60, that's the U.S. economy firing on all cylinders. They're starting to come back off of that a little bit, particularly the non-manufacturing index fell from near 60 back to 55 in July. And maybe that might be some of the early evidence of trade tensions, because I think there is some uncertainty out there. I think that it is impacting business investment decisions, the so-called animal spirits in the business world, and that in turn is going to impact employment and other decisions. So that might be some of the very early evidence of a little bit of drag coming from trade.
Robert, you also talk about a major change to this personal saving rate. Now, what is that change and what does it tell us about consumers?
Yeah, that's going to be a little bit into the weeds because that's not a number we normally track, but the personal savings rate, you can think about it as the percent of your income that you don't spend, and which means how much you save. Now, prior to this big data revision, we had associated with the GDP data, and the income data gets revised at the same time because they're all sort of locked into each other. We had seen the savings rate falling off fairly low to near 2%, which means that consumers are getting a little bit overextended and going to have to lean on credit to keep purchasing going. But with this new revision, we actually see a very different story. Personal savings rate hanging up about 7% really for the last 5 years or so, not moving a whole lot outside of that range. And that tells me that consumers, generally speaking, have a lot more ability to weather a storm. They've got a little bit of buffer around them. They're not overextended, and they're not having to lean on credit to keep those purchases going. Now, that's a very broad view, and I think the savings rate is staying high because of those baby boomers who are saving for retirement, and perhaps some of the younger age cohorts. That could be a different story, but put it all together, and I think it's a pretty healthy savings rate for the U.S. economy.